Hello, everyone. Good afternoon, everyone. Waiting for everyone to connect to audio. Afternoon, everyone. Hope everyone is well today.
Hi, Shazia.
Hi. Hello, hello. Afternoon, everyone. Thank you all for being here. So we'll give everyone else a couple more minutes to join. And as they're joining, I'll introduce our guest speaker for today. So thank you all for coming to our guest workshop today. So again, welcome everyone to today's workshop. Actually our first workshop for the program, which is Entrepreneurial Finance. Our guest speaker today is Simon, who is the Associate Professor and Program Director in MSc Entrepreneurship at UCL. And he today is bringing a wealth of experience. So he's a serial entrepreneur with a wealth of experience, having built up and selling 2 businesses in the last 25 years. So a lot of knowledge that he has to share, a lot of experience that he has to share as well. So we're really grateful to have Simon today, bringing this workshop for you guys. So, and also as a point, before I carry on and have Simon lead this session, it would be great for you guys to have your cameras on for this session, because we want to keep these sessions interactive. So please have your cameras on throughout the session, and I will hand over to Simon.
Hi, everyone. Very nice to meet you. I'm just going to share my slides with you, and hopefully you can now see the profit and loss on there. And I'm just going to rearrange my screen slightly so I can see all of you. For some reason, as always happens with Zoom, I have lost my picture of you. That's very strange. Can you all see me okay?
Yes.
I can.
Yes, for some reason I can't see you. Let me just try.
Yeah, that's just how it's set up normally.
All right.
Oh, what's going on here?
That is very strange. Normally, because I do these classes quite regularly, I can see people. Hang on, I think I worked it out. Right. I've just about worked that out and got you all on screen now. Sorry about this. I've got 2 screens and one of them is new, so that's, I think, part of the problem. But I've now got a wonderful view of all your faces, which is really good to see. Right, so this session is about the profit and loss statement, and the profit and loss is probably the single most important statement a business can have, because it shows you whether you're actually creating wealth or destroying wealth. And what we're going to do to try and understand the profit and loss in a bit more depth is we're going to do an exercise together, and you should have a sheet in front of you or an Excel spreadsheet which you'll fill in as we go along. So it makes it interactive and fun. I've also got some polls for you. Most of these are fun polls, and this is to keep your attention and interest, and hopefully to make the session more enjoyable. And you can also stop me at any time and chat. So put something on the chat if you want, a question, or just put your hand up. And if one of my colleagues could tell me if someone's got their hand up if I haven't noticed it. So do put your hands up to chat if you want to. And at the end of the session, we're going to look at Burberry's accounts together, just really as proof to you that you can understand big companies' accounting statements quite easily. So we're going to start off by looking at a cafe, a fictitious cafe, very simple scenario. And we're going to end up looking at one of the UK's larger companies' accounts, and you'll see that the principles are exactly the same. We're also going to look at the Carl's Cafe financial model. You've had this sent to you already, and I'll just talk you through it. It looks more complicated than it really is, but it's a very useful tool and an essential feature of every business. All businesses should have a financial model of some shape or form. Please keep your cameras on, because otherwise I feel like I'm talking to a brick wall, and it's nice to see your faces and you can wave at me and do thumbs up signs if you understand something, or thumbs down if you don't. So I do appreciate your interaction. Thank you. I wrote a book a few years ago, which has got everything I teach you in and a lot more. I'm afraid the book is quite expensive. That's nothing to do with me. It's about £35, but you can get it cheaper from the publisher, and I sent you a link for that. You can get 25% off it, or you might be able to pick up a copy secondhand. But it really has been written for you, for UK entrepreneurs. I was a bit fed up with all the books available being from the States. So I thought, well, I'll write one for the UK. And it talks about fundraising in the UK and EIS and CDIS and all the things that's relevant to the UK. And all the figures are in pounds rather than US dollars. As my colleague said, I'm an associate professor at UCL, and I run the Masters in Entrepreneurship program. I'm the program director of that, and I've done that for 7 years. And I also teach entrepreneurial finance, and I'm giving you effectively some of my course. I'm also a business angel. I've taken part in about 70 investment rounds and have about 25 live investments at the moment. Angel investing is not for the faint-hearted. I've made some terrible mistakes. I've got some good investments, but I've also managed to lose quite a bit of money on angel investing, and I wouldn't recommend it for the faint-hearted. But I've learned a lot from doing that. This is the business I started back in 1984. I created a chain of picture framing shops in London, and I sold these in 1989. And I'm not in that photo because I was actually taking the photo. And this was a fast picture framing shop, one of the first, or the first in London, where you could take a picture in and get it framed while you were waiting. And this was the more up-to-date looks. We improved the look of the shops. And this shop was actually open until before COVID. It was still open. I've been open about 30, 40 years, amazingly. After that business, I started a card publisher called Card Connection. And this was a business supplying the convenience sector with greeting cards through a franchise network. And this business is now part of American Greetings in the UK. And it's still very much alive and well. And the concept's very clever. The franchisee goes into the store, puts the cards in free to the retailer, services them every month and replenishes the stock. And it's an idea we didn't make up, we just copied it. This is where I'm based. So I'm talking to you now from Farnham in Surrey, just out of interest. And I'm in my study at home, and I'm sitting behind my desk because I don't know if I can show you the rest of my room. I'm sitting behind my desk because if I sit in front of my desk, the light's not very good. So, right, and I'm just going to upset my screen.
Well, it might have lost Simon for a second. We'll just wait for him to come back.
You need to invest in his internet.
Or not move the laptop, right? It's always in sessions like this, I just wanted to show us around and then move the cable or something. And here we are.
But the good thing about him is that he has run a business, because a lot of people with BScs and MScs and PhDs talk academics and they've never run one. So what he's showing is really encouraging that he's been there. So that's,
and he's successfully exited a couple, and he's invested in a lot. So he'll see a lot of things of what goes right and wrong. So he's got
Exactly.
tremendous experience.
Exactly. It makes him very believable.
Yeah.
Yeah.
And I recently used Snappy Snaps to get a lot of pictures done while you wait, and they're really good. So I can see the need for that service. It's a good business. You end up spending quite a lot on those frames, actually.
Mm. And interestingly, he said he lost out on a few angel rounds. I'm very interested in knowing, you know, what his experience was from that. And by the way, Carolina, have you noticed that myself and Marin, we're filling the gap? So when it's time to share the money, make sure that I get some of it, and so does he. We're making sure this room isn't bored. Sonny, why aren't you speaking? Hello.
I literally, I haven't even come up for air today, so I'm leaving you to deal with it. It's fine. I'm gonna go back on mute. I need to rest my voice. It's good to see everyone.
Yeah.
You know, what can I say? I'm always grateful for this. Like there's always one or two people who emphasize with the situation and help me maintain the conversation until the speaker comes back. And I think Simon has just rejoined us, but Sam and Mrinal, thank you very much.
Conversation fillers.
Yeah.
I'm so sorry. My computer crashed. I've never ever had that before. I moved it rather stupidly, and it just crashed on me. So I've never ever experienced that before. So I can only apologise. I'm telling you, I'm going to stick to one screen, because every time as I moved it, if something happened on my second screen, and everything disappeared. So I'm extremely sorry, and I'm just going to stick with one screen now.
That's okay. Thank you, Simon, for coming back. All I can feedback is that as you were gone, there were some comments floating around how excited people are for the session. So we're still in great moods.
Good. Right. I'm just getting my screens organized again. This is so embarrassing. My computer on restarting has opened every single document it could possibly find, so that's not very helpful. So unfortunately, I seem to have lost all my Zoom screen. Right, got that back. Share it with you. Right. Okay. So let's move on. The purpose of accounting, why do we produce accounts? Well, so we can understand what is happening in a business. Otherwise, we're just guessing. So we might think we're making money, or we might think we're losing money, but there's absolutely no point in guessing. We need to know as a matter of fact. And accounting statements are also required by law. And if you're a very, very small business, you have to just file a simple balance sheet with Companies House. But if you're a larger company, you have to file a profit and loss, cash flow statement, and a balance sheet, and a whole load more information. And the larger your business, the more you have to file. So we need to know what's going on beneath the surface of the business. So if you look at this image here, the people are merrily jumping in the water, not knowing what's going on underneath. And a business is a bit like that. You've got to know what is going on beneath the surface of the business. And the more information you have, it will affect your decision making. So if, for example, we've got 3 products and we think we're making money on them all, but we discover actually one of the products is losing us money when we take into account all the costs associated with it, that's profoundly powerful information, and we may decide to discontinue that product or change our pricing. That's just one example of where information is valuable. So what are the three accounting statements? Well, there's the profit and loss, also known as the income statement, the balance sheet, and the cash flow. So these are the three statements you need to understand and understand the purpose of. And the profit and loss you can look at and think of it a bit like a video, because it's recorded what's happened from a profitability point of view over a period of time. So if it's a year, that's from the 1st of January, say, to the 31st of December. That's a continuous period of activity. The balance sheet, however, is more like a photograph because it's taken on a particular day. And in any set of accounts, the balance sheet is on the last day of the trading period. So if the accounts you're looking at, well, for the year to 31st of December 2022, the balance sheet will be as at the 31st of December 2022 on that day. And it's a bit like a photograph because it's showing the assets and the liabilities of that company on that particular day. So it's like a still image. The cash flow statement is showing the flow of money coming in and out of the business. So in a set of statutory accounts, it shows how the money moved within the year. But from a trading point of view, from your point of view, the cash flow statement is a forecast looking into the future of your cash requirements. And so really the minimum two statements you should be looking at as an entrepreneur is your profit and loss statement, in other words, showing how much profit you're making or loss you're making, and your cash flow statement, looking into the future and seeing what your funding requirements are. And all these three are fundamentally interlinked, and trying to understand this is, or if you can understand this, it's very, very powerful indeed. And in fact, it is the key to wealth creation. And, you know, once you've got the basis of this understanding, you're well on the way to being successful in business. And I mentored hundreds of entrepreneurs actually over the years. And the one thing I've observed in common with the successful ones is they all understand the nature of the profit and loss and the balance sheet and the cash flow. And so, you know, if you want to be wealthy, you're going to improve your odds of becoming wealthy or successful in business quite dramatically if you can understand these statements. And one thing to note, which is a bit freakish to point out, but actually the balance sheet is the mother document, and the profit and loss is effectively one line in the balance sheet. And that's really quite a surprising statement, because lots of entrepreneurs don't really pay any attention at all to the balance sheet. And to discover that the P&L is actually just a line in the balance sheet really does illustrate how the mother document, the mother statement is actually the balance sheet. Now, let's talk about the different methods of accounting. The first method, which is very flawed, is cash accounting. And this is just measuring money in and money out in any given time period. So say, for example, in the month, we could just say, well, more cash has come in than has gone out, and therefore performance is good. And this is a completely flawed system for almost any business. So even if you had a very small business, it's completely flawed, and it's likely to lead to failure. And a good example of how flawed it is if during the month I borrowed a load of money, my cash flow is going to look very good for the month because a load of cash has come in. And if I delayed paying my suppliers, again, that's good in inverted commas, because I've improved my cash position, because more cash has come in or not gone out in the month. But of course, that is a preposterous scenario, because suppliers will need paying eventually. And of course, if I borrow money, I've got to be able to repay that money in the future. Now, the proper method of accounting is what's called accrual accounting. And this is when the transactions are, transactions are recorded when they're economically significant to the business, and not necessarily when the cash movement takes place. And as we go through the exercise together, we'll come across lots of examples of this, which will help explain it to you and also help you learn it. And the internationally recognized system is GAAP accounting. It's pronounced GAAP, the generally accepted accounting principles. And this is broadly the same in the USA as it is in the UK. And I'll slowly introduce you to some of these principles. So let's start off with the profit and loss statement. This is really what this lecture is about. So we're not really going to talk about the balance sheet today, but we're going to focus on the P&L. And we produce the P&L, as I said, so we can understand what's happening from a profit point of view. It's not about cash flow. And this is the slightly confusing thing, that we can think, well, in doing a profit and loss statement, we consider the cash movements, and we don't. And cash and profit are closely related, but they're not the same thing. So in this image here are the two twins from one of the Matrix films, and I've got a poll for you so if we could have the poll up, please. The first poll, just to ask you which is the best Matrix film. In fact, there is a Matrix 4 has come out, and you may not actually have seen the Matrix 1 and 2 and 3, but if you haven't, it's certainly worth watching the Matrix film. And in one of the films, Matrix 2, these two terrible twins, and they look the same, but of course they're two different people. And I use this photo really as an illustration for the fact that profit and loss and cash flow can be the same thing, but often they're not, and you have to learn the difference. So can we have the answer to the polls? Share the answer. What have we got? So, so people have seen the Matrix, which is a lot of you have, which is good. And yes, I would say I think Matrix 1 is the best. And these twins are actually from Matrix 2. So I would agree with you, actually. I think Matrix 1 is the best film. And if you haven't seen the Matrix, it's well worth watching. And I don't know what Matrix 4 is like. If someone's seen Matrix 4, perhaps you could put on the chat what you think of it. So could we close the poll, please? And we'll move on now. So what's the difference between gross profit and net profit? Does anyone want to put on the chat what they think the difference is between gross profit and net profit? I see Matrix 4 is terrible. I'd heard that actually as well. So it's interesting. People should say that. So what is the difference between gross profit and net profit? Anyone on the chat? Gross does not take into account cost. Net profit is after costs and taxes. Cost of sales. Well, there's some interesting things raised there. I don't think anyone's given a definitively correct answer. This Race has come close. Net profit is what is left after all costs. Yep, good, Sam, well done. Some very good. Okay, so gross profit is the profit directly from the sale of the product or service before operating costs. And net profit, or profit before tax, as it can be called, is the profit after all costs. For example, wages or rent, and many of these are fixed. So let's look at the most simple P&L I could possibly create. Let's imagine you sell 100 iPhone cases at £15 each, and they cost you £5 each to buy. The first part of your P&L is going to look like this. So sales, £1,500, cost of sales, which we deduct, is £500, giving us a gross profit of £1,000. And you'll see the percentage there, and that is my gross margin. So I tend to use the term margin when I'm talking about percentages, and when I'm talking about gross profit pounds, I just call it gross profit. Now, is 67% a good gross margin? Would you say that's what I make on every product I sell? 67 pence in the pound on the sale of the product is profit. Pretty good, yes. Yeah, I would say it's very good. And as a rule of thumb, any gross profit over 50%, I think you could say is good. Although it's very industry specific. So for example, if you're in the food industry, you wouldn't probably make margins like that. Maybe a 30-40% gross margin might be good in your industry. But as a rule of thumb, 50% is a good benchmark. Now let's imagine my only single cost was advertising of £400. That would give me a net profit of £600, and net profit is the same as profit before tax because there's no taxation in here. And here my net margin, as it's called, is shown to be 40%. So that means my bottom line, my final profit, is 40 pence in the pound. Is that a good net profit, anyone?
Excellent.
Yes, it's an insanely good profit, and unrealistically good profit. 10% would be a good benchmark for what you would expect. But again, this is very industry specific. So for example, the major supermarkets will tend to make about 7% net, and that would be regarded as good for them. And Apple makes just under 30% net profit, which is extraordinarily high. So most businesses that are successful in the UK will be making between 10 and 15% would be a good range of net profit. And the higher the net profit becomes in an industry, the more people are attracted to it. And that tends to bring the net profit margins down. And also it works the other way. If the profitability of an industry is very poor, people disappear. And so the remaining players are able to charge higher prices. So there's natural forces, if you like, economic forces, pulling businesses towards that sort of 10% range. But again, it's very, very sector driven. And as I say there, net profit is also known as profit before tax. And in my book, I use the term profit before tax pretty consistently throughout. So let's look at Carl's cafe now. And this is a story about Carl and his cafe. And Carl's dreaming about lots of things. First, he's dreaming about owning this car. So if we could launch the poll, please, to get an answer as to what this car is. So you have to be quite specific about which car it is. And just give you a few seconds to fill that in. And I think we'll close the poll because we don't want to spend too much time on Carl's car. Let's just see the results. Can we see the results of the poll? It's actually, the majority of you are wrong, actually. It's actually a Ferrari Portofino, but a Ferrari California actually is also correct, because that was the predecessor to the Portofino. In fact, actually, if you add Portofino and California together, the majority of you got it right. So well done. And it's most definitely not a Fiat 500. You can close the poll. Thank you. So anyway, Carl is dreaming about owning a Ferrari Portofino. He's also dreaming about buying a house by the sea, and he's thinking, how am I going to do these things? I've got to build my business up, but I don't know how much money I'm making each month. I know I must be making money because consistently there is more cash at the end of the month than at the beginning of the month, but he doesn't know what his true profit figure is. And so we are going to help him work that out. And we're going to fill in this P&L together as we go along. And you can see on here, we've got sales, cost of sales, operating expenses, EBITDA. And in fact, just to highlight, there are 4 levels of profit shown here. So we're going to work out each of these as we go along. And as we do that, we'll learn something about each of those profit figures. And of course, there is a 5th one, because there's profit after tax. So the tax in the UK is known as corporation tax, and that's paid on companies' profits. So the first question is, Carl's sales in October were £36,000 including VAT, or £30,000 excluding VAT. Which number goes in the profit and loss statement? So £36,000 of cash has come in, including VAT, or £30,000 excluding VAT. What were his sales for the month? If you could launch the poll, please. What were his sales for the month for the profit and loss purposes? Just give you a few seconds to fill that in. And this is an important learning point at the very, very start. Okay, we can see the results of the poll. Good. Well, the majority of you actually have got that right. And it is actually £30,000. VAT, you can close the poll now, thank you. VAT is not a profit and loss item, it's a cash flow issue. So at the very, very beginning of us trying to fill in Carl's Cafe's P&L statement, we run into this issue I talked about of trying to know what the difference is between something that's a P&L item and something that's a cash flow item. So from a cash flow point of view, it's an absolute matter of fact that £36,000 came into the business in the month of October. But from the profit and loss statement point of view, we only record the £30,000 because the VAT element is not the company's. And in fact, VAT is collected on behalf of His Majesty's Customs and Revenue, and it doesn't feature in the P&L at all. And you mustn't treat VAT as your own money. You need to push it to one side, otherwise you can get into big trouble. And VAT fraud is a very good way of getting yourself put into prison for a short period of time. So you should have £30,000 now. Enter that on your sheets if you're using the sheets, or tap that into your little Excel model if you're using the Excel sheet. And you'll see that I've got the words KPI up there. Can you remind me what I mean by KPI? What does that mean? Anyone want to put on the chat or shout it out? Key performance indicator. Well done. Yeah, well done. So this is a critical key performance indicator. So if we're running so imagine we've got 5 cafes around London, every day, or probably every day, we're going to be checking up to see what all the cafes have done. When I had all my framing shops, I had 16 framing shops around London. We didn't have the internet in those days. We had a simple answer phone, and the managers at the store every day would ring up the answer phone and give the sales figure for the day on the answer phone. And in the morning, we'd play this tape back and write down all the figures for the previous day. So we were tracking that on a daily basis. And in most retail businesses, you will do that. So it's an absolutely critical key performance indicator. And if that, if you're seeing the sales are not performing well, you want to do something about it. Now we've got to work out our stock figure. So Now, let me explain stock. So if we have one Mini in stock, if we're a car dealer, imagine, we have one Mini in stock at the beginning of the month. We purchased 3 Minis during the month, and we had 4 Minis at the end of the month. How many Minis have we sold? So could we launch the poll, please, for this? So we've gone and bought 3 new Minis in the month, and we've had 1 to begin with, and we've got 4 left. How many have we sold? So if we can see the results, please. We've, of course, sold none. Well done. Thank you. You can close the poll now. Well done. We haven't sold any, have we? So the message here is that what we have purchased during the month cannot be our cost of sales figure. We have to take into account the stock we had at the beginning of the month and what we've got left. So in this scenario, the cost of sales is going to be the opening stock plus the purchases less the closing stock. And this is, in this situation, is 0. So if we had another example, so at the beginning of the day, Carl had 2 croissants in stock. He brought in 5 new croissants. He sold 3. He's going to have sold 4 during the day. So opening stock plus purchases less closing stock. That is the amount of goods sold. So what we've purchased in the month could just end up in stock. And this is, again, another key learning point of the day. So you've learned that VAT is not included in your sales figure, and you've learned that stock, what you purchased during the month, isn't necessarily your cost of sales figure. You have to take into account the opening and closing stock. So I'd like you now to work out the figures for Carl. So the stock at the beginning of the month was £2,000. Carl purchased £10,000 worth of stock in the month, and at the end of the month he had £3,000 worth of stock left. So I want you to work out the cost of sales, his gross profit, and his gross margin percentage, and enter these on the sheet. So you've got 3 little boxes on your sheet. So put in the opening stock, add to it the purchases, take off the closing stock. That gives you your cost of sales. Take the cost of sales off the sales figure, which you've got of £30,000, and that will give you your gross profit. And what is that as a percentage of sales? So we can see whether Carl's actually got a good gross margin or not. I find in teaching entrepreneurial finance, getting students to actually do something in class is a very good way of learning rather than me just talking. So that's why we do this practical exercise together. So anyone want to share some figures with me, what the gross profit is or the gross margin, if you've got that far?
Simon, we got a poll for the gross margin if you want me to launch it.
Oh, yes, please. Could you?
There you go.
Oh, no, that's the next poll. If you could just, that's not yet. That's a bit later on.
Right.
So you should have opening stock plus purchases less closing stock, which should give you £9,000. So you have £9,000 at that level there, and then you take that off the sales figure to give you gross profit is sales minus cost of sales, and that gives, and gross margin is gross profit over sales. So that gives you, you should have £21,000 and 70%. And well done, Gerald and Ali, for that figure. So that is a good gross margin at 70%, as I said. And this would be an absolutely fundamental gross figure to track. You would track this consistently across all your cafes. What could cause gross margin to decline? Now let's imagine we've got we own 5 cafes across London, and normally we expect our gross margin to be around 70%. And one of our cafes, the gross margin has gone down from 70% to 65%, down to 50%, and we're now concerned. What could be going on? Could we launch the poll, please? The little square in the bottom left-hand corner is the poll marker. So if you could launch that. So which of these items would cause the gross margin percent to decline? And yeah, do you pop it on the chat as well? So which of these would cause, and you can select several of these. Which of these would cause the gross margin percentage? Remember, I'm talking about the percentage to decline. Yeah, Owen says increase in supply costs. That's most definitely one. So suppliers raising their prices is one. Okay, let's see the poll results here. So falling sales would not cause your gross margin to decline because, of course, if your sales are falling, and if we take a simple example, let's just keep it to coffee. So we sell coffee from our coffee shop and our sales fall. Well, we're no longer using any coffee. We're using less coffee. So our gross margin percentage shouldn't actually change under that scenario. Theft of cash, yes, most definitely will affect our gross margin because we've sold our products, we've put the cash in our cash register, but suddenly the cash has gone. So we've got the cost of the product, but no revenue associated with it. Suppliers raising their prices, yes, if we don't pass those increases on to other people, that will erode our margin. And raising our prices should improve our gross margin, so that wouldn't affect it. And theft of stock, again, would negatively affect our gross margin. So if you could close the poll, thank you. So all these items here are things that would cause the gross margin to decline. And all of these are arguably bad, except for the last one. So suppliers raising their prices is bad if we don't put our prices up in line with their price increases. So that would cause our margin to decline. Wastage, if our cafe staff were making sandwiches and throwing half of them in the bin because they didn't sell them, or just they were careless with the use of coffee, and that would cause our gross margin to decline. Discounting, so friend coming in the store and saying, oh, you can have the coffee free, or you can have the coffee half price, that would affect a gross margin. Obviously theft of product, and obviously theft of cash. So in this case, we've got the cost of the product, but we haven't got the revenue associated with it. Now, changing product mix is not necessarily bad at all. And just to illustrate this, let's imagine Carl mainly sells teas and coffees, and his gross margin on teas and coffees is 70%. He then adds a range of sandwiches, and the sandwiches only have a margin of 30%, but he sells lots and lots of sandwiches and is very successful. And in fact, actually his sales of tea and coffee go up. So he's selling even more tea and coffee as a result of introducing a range of sandwiches. but his overall gross margin is now going to be very different because it's made up of two products, coffee at 70%, tea and coffee at 70%, and sandwiches at 30%. So although his gross profit in pounds is going to grow, his percentage gross margin will be a blend of the two. So it may drop to, say, 50%. Just something to bear in mind that changing gross margin is not, a fall in gross margin may not always be bad, but generally it's something that could be bad. And this is a pub in the south of England. I was in there one evening, and I was behind went to the bar and ordered a couple of beers I was with a friend and 2 packets of crisps. And out of the corner of my eye, I noticed that the member of staff didn't ring it up in the till. He just hit the 00 button on the till and put the money in the till. And I know the owner of the pub, so I actually spoke to her and said, I don't think the member of staff rang it up in the till. And she said, what time was it? And I said 9 minutes to 9. And that was a very critical thing to give her at that time. And she said, what was the amount? And I said, it was around about £8, something like that. And I saw her the next day. I was in there, and not for alcohol, man. I went in there with my wife to have a cup of coffee, and she came up to me and she said, you're absolutely right. She said, at that time, there was no sales transaction of that value, but the till was open, the 00 button was pressed. So what was that member of staff doing? Can anyone on the chat or speak? What was that member of staff doing? Theft, yes. How would he have worked that theft? And it was a he. How would he have worked the theft? What process would he have done? Because he put the money in the cash register.
Well, Simon, because I'm not a thief, I won't know what to say. I've got no idea.
Well, I'm glad to hear that you're all wondering how it works. So yeah, he would have kept a record of the cash. And
went back in afterwards to get it.
Yeah, he would later on in the evening. So he would have taken £8. The till would be £8. It would have £8 more cash in than the till roll was expecting, because the till produced out a cash printout of all the transaction, and it is adding up what should be in theory in the drawer. So there's £8 more cash in there because of what he did with me. And later in the evening, say he did it with someone else for £12, then the till is £20 ahead, very roughly. And so he may have at that point thought, well, that's enough for tonight, and just quietly take out a £20 note, shove it in his pocket, and the cash register will roughly balance. And no cash register where you're dealing with lots of cash will balance exactly, because, you know, nothing's ever perfect. So that's how he made his money, because this is why retail is actually very glad to see the back of cash, both because of all the mistakes that are made with cash, and also because of theft. And all the top pub chains, if you ever go into a sort of pub chain, you'll see the way they work, that the member of staff logs their name as they approach the till, and then they ring up exactly what was purchased, you know, pint of lager, packet of salt and vinegar crisps, very precise. And there may even be a video watching the member of staff and actually showing the transactions on the cash register on the video feed. So there's some very sophisticated things you can do, but this pub doesn't have those systems. Now let's look at operating expenses. Now, operating expenses are also known as fixed costs or overheads. So the terminology, you need to get used to the fact there is different terminology in accounting for the same thing. So these are the items that will not change typically if the sales go up or down. So wages would be a good example, though obviously if you're cafe was very busy during over a period of time, you would bring in more staff. But if we look at it on a daily basis, you may have 3 staff in your cafe for the day. That's not going to change for the day, whether you're very busy or very quiet. You're going to have to pay the wages for those 3 staff. So enter on your sheet the first operating cost, which is wages. So just pop that on your sheet. And now let's move on to rent. Now, the rent, Carl on the 1st of October had to pay the next 3 months' rent in advance, which is the way you pay rent in the UK. It's quarterly in advance. And the total rent for the 3 months was £18,000. So could we launch the poll, please? What is the correct amount of rent for October? So we've got a choice. We could either put in £6,000, £18,000, or nothing for this particular month. So what is the figure we use? Can we see the results, please? Well done. Very good. Very good. You're getting the hang of this. And that's very impressive. The vast majority of you have said £6,000. You said £18,000. Don't worry, you're still learning. You're looking at it from a cash point of view. And remember, we're looking at it from the accrual accounting point of view. So we can close the poll now. Thank you. For the profit and loss statement, we're trying to create a true and fair view of the trading situation for the month. Now, if we'd put down £18,000 as a cost for October, we would have we would have had a cost that was unrealistic. It wasn't true because we've got 2 more months to use those premises in. And so we'd make this enormous loss in October, which doesn't reflect reality. And then in November and December, we'd make this fantastic profit because we had no costs of rent at all. So we need to allocate it consistently. Thank you very much for the feedback. I'm glad you're enjoying it. Thank you for that. So it has to be £6,000. Don't confuse it with cash flow. We have a separate cash flow forecast or cash flow statement. We look at cash flows separately. So you should have £6,000 in there. Now enter these other operating expenses for the month of October, and note that the heat and light you're putting in there was a bill for 3 months. You got the bill in and it's for 3 months. So you've got to put in the correct figure for the month. Add all those up, add all your operating costs up, and enter that on your sheet and work out the EBITDA figure, which is the profit, earnings before interest, tax, depreciation, and amortization. Okay, because of time, you can always do this later. In fact, if you enjoy doing these exercises, I can give you, I'll give to Carolina an exercise you can do in Excel if you want for fun, which is along these lines of creating a P&L. So you should have £12,000 of operating expenses, noting that heat and light is £400. You're just allocating 1 month's use of that. And you've got another KPI there, which is the cost of your operating costs as a percentage of sales. And that's something that would be useful to track. So imagine we had our 5 cafes throughout London. It would be useful to know what our operating expenses are as a percentage of sales, to compare different cafes together. And in fact, you go one step further, and I would say I would want to know what the wages were as a percentage of sales for each of my cafes. I'd be tracking that very closely, because that would tell me how productive the staff were. Because if we had one cafe where wages were 30% of our sales and another one where they were 20% of sales, we would know that some staff are generating more business than others. And maybe that's fine, you accept it, but you'd want to ask the question why. So EBITDA is £9,000. Could we launch another poll? You may have heard of the EBITDA as a measure of profit. Earnings before interest, tax, depreciation, amortization become a popular choice. And this is quite a hard question to ask you if you're just setting out on trying to understand this. So just have a guess at this if you don't know the answer. And EBITDA has become a very popular measure with venture capitalists, but is actually a rather flawed measure of profit. It's one I'm not keen on at all. So can we just see the results of the poll? Anyone who's managed to answer that? So it avoids the distortion of depreciation. That is true. That's not the main reason, but that is definitely a right answer. It looks at the profit before the cost of financing. Again, that is actually true because it's before the interest cost, but that's not the main reason. It includes the cost of finance, but eliminates the distortion of depreciation. That is wrong because we haven't got on to finance costs yet. And remember, it's EBIT, so earnings before interest, tax, depreciation, and amortization. It is likely to be the closest figure to the cash flow of the company. And that is the answer, I would say, is the best answer. So well done to all of you who came up with that answer. And that's, I think that's quite a sophisticated question to give you if you are just starting out trying to understand accounting. Obviously, I know a lot of you are probably a bit more advanced in accounting, but well done on answering that question. So could we close that screen, please? Thank you. So yes, that's the reason it's popular, but it is a rather flawed measure of profitability. And if you take the example of a hotel, which I actually give in my book as an example, to measure the profitability of a hotel at EBITDA level is preposterous because, of course, each bedroom costs, in a luxury hotel could cost £100,000 to fit out with all the fancy bathrooms and TVs and everything. And a hotel's got gyms, spas, restaurants, beautiful corridors. Imagine the enormous capital cost of all that in a hotel. And if you don't take into account the depreciation of those assets, then in your P&L, you're not looking at your true profitability. Just see a question from Suni. What's the formula to calculate 40%? It's not a stupid question. It's 12,000 over 30. So we're always using sales as the denominator or the number underneath. And instead of being a profitability margin, we've actually created a cost margin, so to speak. So your sorry, let me just go back a slide. So your EBITDA is £9,000. Now let's look at depreciation. When you buy assets such as machinery, it's going to fall in value and it's going to decline in value as you wear it out. So if we're a manufacturer, we build a factory and put a bottling plant, build a bottling factory, all of that cost is going to have to be accounted for in some shape or form, and all that machinery we bought has got a life and is going to run out at some point. Now, we don't take the cost of all that equipment to the profit and loss in the first year. We will spread it out over the life of the asset, and that is the whole point about depreciation from an accounting point of view. And the way we do it is we say, well, the life, how long will the asset last? So in this example here, I've said the asset, we buy it for £1,000 and it's got a 10-year life. So we draw a line between the two, and this is called straight line depreciation. And we say, well, it's going to be worthless in 10 years. And we're going to charge the profit and loss £100 or 1/10 of the cost of the asset in the P&L every year to give a uniform allocation of that cost. Note, it's not about cash flow, because the cash flow has gone out of the business on day one. You know, when we bought that asset for £1,000, the cash goes out day one, but we're going to use it for 10 years and charge £100 a year. There is another form of depreciation called reducing balance, where you reduce it as a percentage, but I'm not going to go into that now for time. Just say there are two methods. So how would you calculate this depreciation from computers, given the exponential growth in computing costs? Well, the standard practice for computers is, I believe, 3 years. You'd ask an accountant what the life of any particular asset is, but typically computers are depreciated over 3 years. So you just say you bought a laptop for £3,000, you charge the P&L £1,000 each year for that, and at the end of the third year, your computer would be worth 0 in your balance sheet, but it doesn't mean you don't carry on using it. You may carry on using that computer for 5 or 6 years, but there is no accounting cost associated with that because you've taken that during the first 3 years. And this is why mature businesses can be very profitable, because their assets have been fully depreciated and they're carrying on using them. Can depreciation be non-linear? Yes, it can be reducing balance. So you could, for example, depreciate an asset, and you would do this for a car at 25% per annum, which would mean that after the first year, it drops by 25%. And then the following year, it's 25% of that reduced amount. So you actually end up with a nice curve. Again, if you can get a hold of a copy of my book, all of that is illustrated in there. And I mean, you don't need my book to read up about that. You can always just Google it. So I want you to work it out for Carl. Carl's shop fitting cost £90,000. He's writing it down over 5 years, which is quite a fast rate of depreciation, but it makes the mathematics easier for us. What depreciation should he charge for October? So do you want to put that on the chat, someone, when you work that out? Just to give you a bit of a clue. So he's saying that, you know, the life of these assets is 60 months or 5 years, and as we're doing it on a monthly basis, £1,500, correct? Well done. So we would enter that on a sheet and calculate now your operating profit. Now, You should have, sorry, I've done it for you, £7,500 operating profit. And I'm a great fan of operating profit. I think this is a very, very good measure of profit, providing you have done your depreciation calculation correctly. Your depreciation should truly reflect it should be prudently done. In other words, you're probably depreciating assets faster than their real life may be, and then as opposed to slower than the real life would be, then your operating profit is a really, really good profit figure. It really shows what figure the business is making before the cost of funding. And so operating profit is also known as EBIT, earnings before interest and tax. It's a really good measure of profit. So now let's look at the finance. So the loan repayments. During the month of October, Carl paid the bank £1,700, £500 in interest charges and £1,200 in loan repayment. Which number goes in the profit and loss? Could we launch a poll, please? So you've actually got three numbers there. £1,700 of cash has gone out of the business for the month. He's paid, of that money that's gone out, £500 is interest and £1,200 is loan repayment. Which figure goes in the P&L? Could we see the poll results, please? Now the majority of you got this wrong. It's actually £500. The £1,700 is wrong. You see, this is again you coming back to you being fixated on cash flow when you're looking at the profit and loss. So we can close that screen now. Thank you. So a loan repayment or loan drawdown is not a profit and loss item. So imagine I've gone to the bank, I've gone to HSBC, and I've borrowed £20,000 to start my business. And I come to you and I say, oh, it's great news. You know, I'm starting my business. I've been to the bank, they've lent me the money. I've got £20,000 in my bank account to get going. Have I made £20,000 profit? No, I haven't even made a sale yet. I haven't even begun trading. The £20,000 is the cash flow movement. My balance sheet has changed. I've got a liability. I've got an asset now of £20,000 of cash. I've got a liability of £20,000 to the bank. So there's been changes within my balance sheet, but I haven't even started trading. I haven't made a profit. And equally, if during the month I'm running a business, I decide, oh, I've had a very good month, I'm going to make an extra repayment of £20,000 to the bank. I haven't lost £20,000. All I've done is rearrange my balance sheet. Now, the £500 interest is a cost, because if you think about, Carl renting his premises, he's paying rent each month for the use of those premises. And money is actually no different. We just use different terminology. He's gone to the bank and he's renting this money, and the cost of renting the money is £500 a month. And of course, we don't call it rent, we call it interest. But effectively, he's renting the use of that money. And so that is the figure that goes in the P&L. And forget about cash flow. If we were doing a cash flow forecast, yes, of course, we would have the £1,700 going out, because that's the cash movement, but this is the P&L. And the last thing to note is an arrangement fee would be a cost. So if you're drawing down a loan and the bank make you £1,000 charge for organising the loan, that would be a P&L item in the month you actually took it. When you say he paid the bank, do you mean he took a loan? No, this is his loan repayments. We don't know the size of his actual loan. His loan may be £30,000. this is the amount he's had to pay back this month. So he's paying £1,200 back each month. We don't know what the loan size is. So enter that on the sheet, then work out the final profit figure. And this is the net profit or profit before tax. And what is the net margin percentage? Ali's actually put it on there for us, but try and work it out yourself. So that's your net profit divided by sales. So note all the way through here, our denominator, the number we're dividing by is always sales. So you should have £7,000 profit for the month, which is 23% net margin. And again, an absolutely key performance indicator. So we've highlighted all these key performance indicators, but actually you could be using EBITDA, operating profit, or wages. As I said to you, I would be tracking wages as a KPI. So you could use whatever KPIs you want. And this is, again, another really key lesson for you is as you start to trade, there are certain figures that would be very relevant to you for your business. In this scenario, I would be looking at wages and gross profit very, very closely, because they're two figures I could control quite easily. I can control gross profit by changing my pricing, by reducing, by trying to change suppliers to get lower prices. So that's something I could track. And wages I can track very closely. I can increase or decrease the number of staff in my cafes. So they're very much things that I would track. Now, just dealing with some of these questions here. Why isn't CapEx included here? Capital expenditure is a cash flow issue. If I buy, well, let's go back to Carl's example. He's bought all this coffee machines and furniture for his store. That is CapEx, capital expenditure, and that's gone out day one when he started his cafe. That's a cash flow issue. Where CapEx turns up in the P&L is in depreciation. So that's taking into account the use of those capital assets over a period of time. What is the benchmark for EBITDA for an SME? That's a very good question, actually. I don't know of a good benchmark. And I think that is very hard to pin down because depreciation will vary so much. If you've got a software business, you're not going to have hardly any depreciation, whilst if you're a hotel, you're going to have enormous amount of depreciation. So I would say EBITDA would best be very, very sector specific. I don't think you could give a general one for that. Just to clarify, if there's no massive fixed assets in your business, should you consider EBITDA not as a critical measure to check the health? Well, again, this comes back to why EBITDA is a bit of a nonsense figure, because if you've got no depreciation, you might as well use operating profit. Operating profit is a really good measure. And we'll look at Burberry's accounts in a minute. So Carl says to us, I know how much money I'm making each month. Can I order the Ferrari now? So he knows he's made £7,500 in October. Can he have his Ferrari? Could we have the poll, please? And you're the decider. You decide, can Carl have his Ferrari or not? So what do you think? So is Carl going to get his Ferrari or not? And can we see the results, please? Oh, you're a mean lot. So the majority of you say he can't. Now, why can't he? Well, there's some really key issues here. Why? You're absolutely right. He can't recommend he gets his Ferrari. There's some key reasons why. Can you close the poll now? Thanks. bad investment. Well, actually, Ferraris can go up in value if you buy the right ones. Taxman hasn't gotten his money yet. Well, yeah, actually, you're right. Yeah, we don't know what his tax bill is. There are many issues. I mean, the first thing is we know he's made a good profit for the month. £7,000, 23% is good. As you rightly say, he hasn't paid his tax yet. But what did he make last month? Has he been making money in the past? And what's he going to make in the future? £7,000 isn't going to pay for even the finance on a Ferrari. So, you know, he's just, we just completely in the dark. He's made a great profit for the month, but a Ferrari is a huge amount of money. I mean, they're about nearly 200,000 quid, those cars. It would be crazy to go and buy a Ferrari now. So I hope that's been helpful in trying to understand the P&L statement. Just want to go through with you Burberry now. And this is really just to say to you, look, you've done a cafe and you could say, well, it's all very well. Simon's taught me this silly cafe. That's not real life. It's just a fun exercise. It's going to be of no use to me at all. Well, hang on a sec. Let's just have a look. This is Burberry, one of Britain's bigger companies. I think it's in the FTSE 100 index. And we can see its sales revenue there. So for the year to April 2022, 2.8 billion, up 20% on the previous year. So we can understand that. Cost of sales is shown and a gross profit of 2 billion, 21% up on the previous year. And we can see the gross margin there at 71%. I mean, I've written these in on here for you. They've actually improved their gross margin slightly. And again, we can say that is actually a very healthy gross margin. Now, interestingly, when you look at these accounts for these large public companies, they don't use EBITDA. EBITDA is not used in when these corporate accounts are produced, or is rarely used. Sometimes you see it. And they just put their operating expenses in here, which will include depreciation. So they just put all their costs together in there, and their operating profit is 543 million, very slightly up on the previous year. And you see actually their operating expenses have grown at a much faster rate than their sales did. So whilst all this top line is really quite good, the sales performance is good, gross margin is improved. So all of this is good. When we get down to the operating expenses, they've grown at a faster rate than sales. So the operating profit has grown at a slower rate of 4.2%. Then they show their interest. So this is EBIT, interest costs in there, £32 million, about the same as last year. And so the profit before tax, or net profit, is 511 million, which is 4% up on the previous year. And note, I put in the margin there, 18%, slightly down on that, but that's a very good net margin. Burberry is a very profitable company, 18% net margin. Now, in the UK, companies pay what we call corporation tax. When you look at American accounts, they call it income tax, which is terribly confusing, because income tax is what I pay on my salary to UCL, and if you're in employment, it's what you pay to the government on your salary. So to call it income tax is very confusing. But in the UK, we call it corporation tax. And the rate, I think, is currently around about 19%. And this is going to rise to 25% next year, I think, from memory. So they've made a profit after tax of £397 million. And that is the money that will go in three directions. Does anyone on the chat want to say to me where that money, what are those three directions that money, sorry, there are only two directions that money is going to go in. What are the two directions that money is going to go in? Anyone on the chat? Back into the business is one, and shareholders is the other. Well done. Yeah. So it's either dividends or it's retained in the business. And obviously, if it's retained in the business, it could be used for various things such as reducing debt, or the Portofino fund. I like that. That's a good use of money. So certainly if I owned Burberry, I would definitely go and buy a Portofino, because if I made 397 million, a Portofino would be loose change. Just finally, if you divide the number of shares in issue, bad for the environment. Yeah, that's true. That's true. But the Ferrari are bringing out electric cars that are coming through. And so that would justify buying a Ferrari. So if we divide the number of shares in issue, so obviously there are millions of Burberry shares in issue, into the profit before tax, we get the earnings per share. And so if you owned a Burberry share, it's earning you 98 pence a year, and that's grown from 93 pence from the previous year. And this is one of the critical measures that will actually drive the share price. So I don't know what Burberry's share price did in the intervening period, but that would suggest to me that their share price would have risen during that period. And the stock market will also be looking ahead and thinking about the earnings the year after. And if the expectations are good, then the stock will rise. And just interestingly, we're in all gloom and doom economically at the moment. In the UK, we're all thinking how miserable life is, and we're all short of money and misery, misery, misery. Yet the FTSE 100 index recently touched an all-time high. And this may seem to be bizarre, but actually it's a reflection of the fact that the stock market thinks well ahead. So the stock market is seeing very early signs that interest rates are peaking and the pain is over and there are good times ahead. So that's the principle. Now, I just want to talk about financial models very quickly, and then I'm going to show you a couple of examples. So we produce a financial model. Well, what is a financial model? Well, typically it's an Excel spreadsheet forecasting the profit and loss, cash flow, and the balance sheet into the future. And why do we produce such a model? Well, as this lady's looking at a crystal ball, it's literally so we can see ahead, we can evaluate our business. So if you're doing a model for your startup, it allows you to say, well, is this going to make any money or not? You know, and oh crumbs, it's not going to make any profit if I do that. What if I change the pricing? What do I reduce the cost structure? What if I increase the sales? How does it look now? And so you can test out different strategies. And of course, when you're happy with those numbers going forward, you say, well, I think this is all realistic. You know, I reckon I can do this sales. I put in the correct cost structure. I've done lots of research. This will tell you how much funding you need for your business. And if you are raising money, so if you're going to a bank or talking to investors, they will ask your financial model. So if you came to me, for example, and said, Simon, would you invest in my business? First thing I'd say to you is, assuming I like the sector, I'd say, well, send me your pitch deck. So I would look at your pitch deck. And if I like that, I thought, oh, well, this is a really interesting business. I'm very interested. I would then say, send me your financial model. So the financial model follows the pitch deck. And if you turn around to an angel like me and you said, well, I don't have a financial model, I would say to you, well, as politely as I could, I'd say, well, you need to go off and get someone to build one for you, because otherwise you're just completely in the dark. It also becomes the basis of the company's annual budgeting process. So as you're coming to the end of your trading year, you will have a model looking at the whole of next year and possibly beyond, and you'll be able to say what your bank account theoretically will be in 1 year's time. So some general rules about modeling. Firstly, keep it simple, stupid, or that expression KISS. Don't make it too complicated. Your forecast is going to be wrong, And no forecasts are ever right, but what you're trying to do is get the general wind direction, so to speak. And you're damned if you make it too optimistic. So if you show it to investors and it's crazily optimistic, they're going to say, well, I'm not, doesn't look realistic. But equally, if it's pessimistic, they're going to say, oh, this is a business not very successful. It's not going to make much money. I'm not interested. So you seem to be stuck between a rock and a hard place. And I recommend with models to keep it simple. I make all my models with yellow cells where you change them. I'll explain that in a minute for you. So Carl is thinking, you know, if I'm going to get my Ferrari in my house, I'm going to have to open more cafes and create a much bigger business. I need a business plan, and part of that will be to do a forecast, so looking at the next 3 years of his business. And I'm now going to share with you a actual financial model, if I can find the blooming thing. Let me just So I've given you this model to look at, and this is based on 10 years of doing these, actually. So the models change quite a bit over the years, and there's quite a bit of explanation in here about the process of financial modeling. That's quite worthwhile reading to understand what is going on. But this is a very good teaching tool, and in it I've got all your operating costs. So just at a simple level, say the rent is £32,000 next year, or this year rather, and next year 40, and 40 after that, and all these variables I can change. And then it goes 3 years ahead, 36 months ahead, and I've got the variable costs, so number of customers coming in per day, how much they each spend, number of staff I've got per day, and my gross margins. There are all sorts of assumptions, again, kept really simple. And this calculates my P&L for the month for me. And so I can see I'm making a profit before tax. I start to make a profit in May here. And if I change any of these yellow figures here, so say instead of 100 customers coming in, I put in 130, it will recalculate the figure, the profit figure for me down here. And this is all shown graphically. So that's my annual sales and profits. And most importantly, it does a cash flow for me. So this is the cash flow. So all the money going out as I start my shop fit, or Carl starts the shop fit, and then all the cash coming in as I start trading after that. And one thing to note here is Carl hasn't got enough contingency. So you don't fly an aeroplane just 50 feet above the treetops. That's all you need, 50 feet above a treetop, because you're not going to hit the tree if you're 50 feet above it. But of course, you'd never fly an aircraft 50 feet above a tree, because what if something goes wrong? You've got nothing left. You're just going to drop, if you drop slightly, you hit the trees, you crash the plane. So running a business, you never, ever would trade like this. And I make this point here that Carl hasn't got enough contingency. So that's part of a learning point. So you've got a P&L forecast for 3 years. You've got a cash flow forecast for 3 years. You don't actually need to change any numbers in there. It's all automated for you. Balance sheet forecast. And again, if you're at the early stage, if you're early learning about this, you could almost ignore that. And then you've got a nice little summary page. And you can cut and paste this. This will do your P&L forecast, and you can just cut and paste that into a PowerPoint presentation or a pitch deck if you want. So lots in there. Just going to show you the other one, the Davis design model, because this is the one I would recommend you actually use if you want to use my model as a template. So I'm just going to share that one with you instead, and I'll explain why. So this is basically the same model with a different front end, and I've colored it in blue just for simplicity, just for differentiation. But this starts off with a pricing model. So here you could create your products. I've got products 1, 2, and 3. All the selling prices. I can change the selling price of my product, and I can change the cost structure of the product, the components. And then for my sales forecast, I've got the number of product A I'm selling month by month for 3 years, and the number of product 2 and the number of product 3. So for your business, you can create as many or as few of these as you want. Just tap in the yellow boxes, the volume, and you can change all the pricing here, which will automatically do your gross margin calculation for you there. So I can see we're at time, but I'll just keep going. If you need to go, obviously go, but I'm conscious that I disappeared for you. So we'll just keep going if that's okay with the team. Just let me know if it's not. There's also a little subscription model here. So if you have a subscription business, you can do a forecast for subscribers in here. So it's a little bit more flexible, and the rest of the model is exactly the same. So for you to use this model for your business, all you got to do is go to the yellow boxes, put in zeros, just make everything 0. You can overwrite these headings if you want, and just clear the model out of numbers, and then slowly enter in your descriptions and your figures, and the model will populate itself with all your own numbers. Lots of guidance boxes here. If you don't, well, you know, once you've read that, you can just delete that, or sort of delete the box from here. You can do what you want with this to build your own model. It's completely copyright free. There is only one copyright condition, and that relates to academic assignments, which doesn't apply to you. So you can do what the heck you want with this model. You can share it with whoever you want. So just to do I'll just do a little summary for you, and then we'll finish. So let's just go back to sharing my slides with you. So quick recap: we produce accounts so we can understand what's happening in the business. Otherwise we're guessing. Otherwise we're in the dark. We don't know what's going on. Profit and cash are closely related, but not the same thing. And you have to learn when something is a P&L item or just a cash flow item. And you've got to learn that. And, you know, we've been through some of these today. Gross profit is the profit on the product or service. What's net profit or profit before tax is the profit after all other costs. This is all before corporation tax. It's not about tax. To calculate the cost of sales, we have to consider the opening stock and the closing stock. Otherwise, what we've purchased could actually all be going into stock. So that's a key learning point from today. And we just got to learn that formula, you know, opening stock plus purchases less closing stock. That's my cost of sales. Interest costs are included in the P&L statement, but a loan repayment or a loan drawdown is not a profit and loss item. Depreciation is the charge we make to the P&L for capital expenditure. So this is where capital expenditure shows up from a P&L point of view. These are the chapters of the book that relate directly to this lecture if you want, and you've got these lecture slides which will be given after the lecture, so if you wanted to make reference to the exact chapters, that's a marker slide for you. I'll also give you a little exercise to do in Excel, which it will tell you whether you've got the answers right or wrong, and you can just do this on your own if you want to. I'll put that in the Dropbox that I share with Carolina. And if you want to email me about that exercise, it will tell you itself whether you got the answer right or not. But if you can't understand why you can't get it right or you didn't, just drop me an email and I'll have a chat with you. So that's everything I've got for you today. Do email me if you want. Yes, you can have both models. They're in a Dropbox for you. The discount from the book is in the briefing document I sent you, and it's in the same Dropbox again. There's a little description about this course exercise. Just go on there and you might be able to get a second-hand copy because there must be quite a few around now. Do you have your email address? I'll give you my email address here. So that's my email address.
Cool. Okay. Thank you, Simon. And thank you everyone who attended today. And thank you everyone for the feedback that you're giving in the comments as well. We really appreciate all the feedback, and I'm sure Simon really appreciates it as well, seeing all the useful feedback that you guys gave as well. And a few comments about taking you back to your uni days, which is good to hear. So thank you everyone. Just a reminder just a really quick reminder about the tectonic drop-in sessions. So there are 4 happening over the course of 2 weeks. So one is actually happening tomorrow, or 2 of them are happening tomorrow, and then 2 of them are going to be happening next week as well. So if you haven't registered, please register, as spaces are limited, but there are still a few spaces left. So that's our quick reminder. But other than that, thank you everyone for attending. Thank you again, Simon, for today's session. We're really grateful for you to share your knowledge and your experience with our founders. And yeah, with that, we'll see everyone soon. And we'll just let you go.
Thanks
Thank you,
very much.
everyone.
Cheers, Simon.
Bye, everyone.
Bye.
Lovely to
Thank
meet
you.
you.
Bye.
Bye.